Now, I'm going to introduce our speaker for today. He is Mr. CY Saw Chen Yen. He's currently the lead trainer for Excellent. He's also a chartered market technician, CMT chartered holder. He has more than 10 years of trading experience in both local and also international stocks and futures market. His experience in providing risk management consultation using derivative instruments for hedging, and he's also a certified HLD Corp trainer and also NLP. He's a performance coach with extensive experience in coaching individuals with performance improvement, behavioral change, self-empowerment, and also personal breakthroughs. His specialties is in trading system and strategies, trading psychologies, and also coaching. So without further ado, please allow me to pass it over to CY.
Thank you for introduction, and good evening everyone, and welcome back to the LLF webinar. Today we are going to talk about from stocks to futures and how to trade futures successfully for beginners. And did you know that futures market has some of the unique features that you can take advantage of that usually in the stock market that you are unable to do it? And as you may have noticed, the stock market and futures market are entirely different markets, each with its own unique characteristics. However, many people who have entered to the trading world tend to trade almost everything right. You trade without having a clear understanding of why you trade that particular financial products. So most of the time when people come into trading, they trade almost everything, thinking that as long as you make money from the market, then that's the product that you go for. But in fact, that is for very newcomers in the market. But as you progress your trading journey, so this is where it is necessary for you to understand and learn some of the fundamentals and foundations of trading, so that you have a good foundation built up, so that you can prolong your trading journey. And I believe today some of you here have many trading years of experience in stock trading or even stock investing, right? Some of you here have been trading for a couple of years, and some of you are just beginners who are just starting your trading journey. So regardless of what background or trading experience you come from, it's essential to always go back to the fundamentals and foundation in trading. So today's session would be something you have already know about, so you can have a quick revision and refresh your knowledge. While for a majority of you here who are beginners, who are just starting your futures trading journey, so today's session would be something new to you. When you understand today's topic, you are already considered as already an entry level in understanding or learning fundamental analysis. So this is where you can avoid some of the unnecessary trading mistakes and accelerate your learning curve in trading. And besides that, you can see futures trading from a different perspective and discover how futures trading can provide you trading opportunities that you may have overlooked. Okay, so let's get started, and I encourage all of you take notes and ask a question during the Q&A session. And by the end of it, you will gain a better understanding about how futures trading is definitely relevant for you and how you can take advantage of the futures market. Now, before we begin, I want to give a quick disclaimer. This presentation is for educational purposes only, and it's intended to give you a general understanding of trading concepts. It's not a substitute for detailed study and the development of effective trading methods. You still need to put in some efforts on your side to develop trading strategies that suits your individual needs. With that being said, I hope that today's session will help you widen your horizon and expand your knowledge of trading. Whether you are a beginner or an experienced trader, I believe there's always something new to learn, and I'm confident that you'll find value and insights I will be sharing today. As Ting Ting has already mentioned earlier, my name is Chun Yen, but you can simply just call me CY. First and foremost, my professional background lies in the field of finance and trading, and I have dedicated quite a significant portion of my career to understanding the intricate world of financial markets and exploring the dynamics of trading. However, my expertise extend a little bit beyond the realm of traditional finance, because I'm particularly passionate about a niche aspect known as trading psychology. So the psychology aspect of trading is about understanding how emotions, how our thinking biases and decision-making patterns influence our trading action and behavior that ultimately affects our trading performance. So without further ado, let's dive into the content and explore the foundation of futures trading. Now, I will be diving today's session into 4 key topics that will help you understand the futures market better. So the first topic would be I will go through some of the understanding that so that you are able to know what is the structure of futures market, because futures market is different from the stock market. So it's important to know this and who are the key market participants are. And topic 2, I will share with you the benefits and uniqueness of futures trading. As a trader, okay, when you really trade in the market, you don't trade everything in the market, and you want to find financial products that can help you not just only to diversify your portfolio, but also enhance your overall portfolio return. And the topic 3, I will share with you about the types of futures market. When you understand the types of futures market, then it's easier for you to do your analysis, especially fundamental analysis. Different types of futures market emphasize on different aspects. And lastly, topic number 4 would be on the futures contract specifications. Here, I'm going to share with you a few examples of how futures contract work and how you can benefit from futures trading. So are you ready to get into the world of futures trading? So if you are ready, you can type in yes in the chat box, and we will begin soon. Good. I see many of you have typed yes. Now, before we begin, let's take a quick poll. Although I know that thinking earlier on has already asked this question, whether you have started your first futures contract or not. And early on, I see a lot of people type in no, and many of you who are still quite new in futures trading, right? So later on, I will be sharing with you how you can actually take advantage of futures trading and futures contract into your portfolio. So in fact, today's webinar, today's session, it's about sharing with you what is futures contract about and what are the mechanisms and background of futures trading. So in fact, today's topic is the first step before you enter into fundamental analysis. So this is where you need to understand the financial products first. You need to understand what are the things that you're trading, so that when it comes to fundamental analysis, when it comes to analyzing the product, the market that you're trading, so that it's easier for you later on. Okay, so whether you are new to futures trading or have several years of trading, you'll notice that once you add futures product into your portfolio, you can not just only enhance your overall portfolio return, but also have a well diversified portfolio. So please stay tuned until the end to get the most out of this session. Now, in this topic, understanding the structure of futures market, I'm going to share with you a brief history of futures market, how and where a futures market come by, the structure behind futures market. It's quite important for you to know this so that you can appreciate and understand what is futures market all about. Because once you know this basics behind, when you trade futures, more or less it gives you a certain sense of confidence and understanding of how the market actually works. Now, the history of futures exchange, it actually dates back all the way to 18th century when the Dojima Rice Exchange, which was established in Osaka, Japan. So the Dojima Rice Exchange was created to standardize the quality and the price of rice. So which was quite an important commodity in Japan at that time. So the exchange actually allow farmers and traders to buy and sell rice contracts, which would actually guarantee or lock in the price of rice at a future date. And then later on in the 19th century, futures exchange starting to emerge in those European and United States. So somewhere around 1848, the Chicago Board of Trade, which in short we call it the CBOT, was founded in United States in order to trade those agricultural commodities such as corn and wheat. The CBOT was established the first futures contract for corn, and later on they started to develop other agricultural commodities futures such as wheat, soybeans, and other futures product. So before I move on next slide, I would like to ask you one question. Now, from this slide, can you see what are the common patterns of what products do these futures exchange actually trade? Okay, I repeat my question. Can you see what are the common patterns of what products do these futures exchange trade or not? If you know the answer, you can type in your answer in the chat box, so that later on you this is the very simple thing that futures market, in fact, it begins with one thing. I see some of the questions coming in. You are correct, which is agriculture as well as commodities. Food not so, because food is something that has already been processed. So in fact, for these futures exchange, they started with commodities. They started with raw products, raw materials that has not been processed yet. So especially for agriculture products that cannot be stored for a long period of time. So agriculture products like rice, corn, wheat, so these products have a limited shelf life. So which is why futures exchange begin to come in to facilitate the trade for farmers as well as for traders. So now that you have already know the brief history of futures exchange, now let's understand where does this futures exchange actually came about. Now, the futures exchange, the development of futures exchange actually allow both sides of party, which is the producers as well as the consumers of the commodities, to actually hedge against price fluctuations. Let me give you an example. A farmer who wants to actually lock in the price for his crops before harvesting can actually sell a futures contract to ensure that he will actually receive a fixed price for his product at a future date. While similarly, on the other hand, a manufacturer who also needs a certain commodity to produce end product, for example, they want to produce bread or even food, they can buy futures contract to lock in at the specific purchase price. So, which is why these allow the manufacturer have a predictable cost of raw materials. Now, imagine this. There are many farmers and there are many manufacturers, buyers and sellers. All of them are strangers and they do not know each other, right? Think about this. If you want to do business with someone that you don't really know, the risk is definitely high, right? It's pretty risky. So this is where the futures exchange comes in as a middleman to facilitate the trade, to minimize the risk in trading. So all of the futures contracts are considered as a standardized contract. Farmers wants to sell their commodity must ensure that their product must meet a certain specific quality and standards. While for manufacturers who want to buy must have the necessary money to buy those products. So with these standardized contracts, the risk for both parties can be minimized as much as possible. So here you can see over the time, futures exchanges expand in to include other commodities such as metals, energy, and even financial instruments. And today you can see that a futures exchange such as the Chicago Mercantile Exchange, CME, and Intercontinental Exchange, ICE, they are the global marketplace that actually allow traders to buy and sell futures contract on a wide range of commodities and financial products. So you can see the futures market became an important tool for managing risk and price discovery, and it continues to evolve with advancements in technology and new products. And similarly, here in Malaysia, we have Bursa Derivatives Malaysia, BMD, in short we call, which is also a futures exchange in Malaysia alone. So there are numerous futures products that you can trade in Bursa Derivatives Malaysia, such as FKLI, FM70, FCPO, FEPO, FGLD, and more. Now, what is a futures contract, you may consider? So simply speaking, is that futures contract is like making a deal with someone in order to buy or sell something in the future. So which is why the name called futures contract, right? Futures. You are making a deal with someone to buy or sell in the future at a price that both of you agreed on today. So let me give you an example. Let's say you are a farmer and you grow wheat. You want to make a deal with another buyer to sell them at a certain amount of wheat in 6 months time at a specific price, even if the price of the wheat changes in the market. So the buyer for the futures contract is actually promising to buy the wheat from you at that specific price, and that you are promising to sell it. So by making this deal, both of you lock in at a price, and both of you are protected from any changes of the market price of wheat during at that time. Whatever price of the wheat changes or fluctuate at the time, it has nothing to do with both of you, because both of you as a buyer and a seller, you have already locked in your price. So here you can see that futures contract are used for a lot of things, like things people grow or mine, such as wheat, corn, crude oil, crude palm oil, gold, and also for financial products like stock market indices, as well as even for currencies. Futures contracts are all about two important things. Okay, you just need to important these two keywords, which is the specific price and specific time in the future. It's only these two keywords, specific time and specific price in the future. So you make a deal with someone to buy or sell something in the future at a price that you both agree on today. That is specific price. You also agree on a specific time, which is in the future, that will be where the deal will actually happen in the future. So basically, a futures contract is a contract for something that will happen in the future at a specific time and price that both of you agreed on today. So now that you understand what is a futures contract, so let's get into who are the key participants in futures trading. So unlike the stock market, futures market, it has a different types of participants who trade the market. So let's talk about the main ones. First, there are hedgers. There are people who actually produce or even use those physical commodities, and producers like farmers and plantations, and commercials like manufacturer companies. They actually buy commodities. So here you can see both of them use futures contract to protect themselves from changes in the market price by buying or selling futures contract at a certain price. They use futures contract to lock in their commodity price. And then later on, there are traders. So sometimes we call them as speculators. So these people mostly buy and sell futures contract in order to make a profit. So they can be retail traders, individuals like you and I, who trade their own money, or even institutional traders like institutional funds like hedge funds or commodity trading advisors. They trade futures in with a hope to make a profit out from it. And finally, there are these what we call as arbitrageurs. Now, let me give you an example to understand what arbitrageurs actually do, because it's quite a jargon for you to understand. But in fact, arbitrageurs is very easy for you to understand. So let's say a popular luxury brand of a handbag, okay, LV bag, Louis Vuitton, is being sold in France for 1,000 euro, and based on the, let's say, current foreign exchange conversion is actually $5,000, okay, for 1,000 euro. But in Malaysia, the same bag that is being sold is actually 7,000. So an arbitrager might see opportunity here, and they might buy a large quantity of the bag in France for 1,000 euro per bag, and then ship it to Malaysia and sell it for $7,000 per bag. So by doing this, they can make a profit around, let's say, 1,500 per bag after taking into account for shipping costs and as well as any other expenses. So this is an example of arbitrage opportunity where there is actually price difference for the same product between two different markets, and they take this advantage by buying something at the lower price in one market and then selling it for a higher price in another market. So by doing this, they can make profit by taking a very minimal risk. So in summary, all you need to understand that when it comes to trading to the futures market, there are three different kinds of market participants in the futures market. There are hedgers, traders, as well as arbitrageurs. So here are the list of futures products that are available for you to trade in Bursa Derivatives Malaysia BMD. And we have plenty of commodity products, equity derivatives, financial derivatives, as well as securities futures. And the most popular and highly liquid trading products are the FCPO and FKLI. Now let's go into the second topic, which is the benefits and uniqueness of futures trading. There are several limitations in the stock market, so that's where you can actually take advantage of in the futures market, because things that you are not able to do in the stock market, you can actually do it in the futures market. Understanding the benefits and uniqueness of futures trading is actually essential because it allows you to effectively manage risk, discover as well as leverage trading opportunities. You can also use futures to diversify your portfolio as well as potentially generate profits. Now, generally speaking, if you look across websites or even other reading materials, you will see these 5 major benefits of futures trading. In fact, there are more. And I'm going to share with you and elaborate even further and each and every point in the next few slides. Now, the first benefit, of course, is a futures product. You can actually trade both directions. And futures trading is unique because it allows you to profit from both upward movement as well as downward price movement in the market, as you can actually buy and sell futures contracts. Unlike the futures market, unlike the stock market, where you can only make money when the stock price actually goes up, futures trading gives you another extra opportunities to make profit, which is during a downward price movement, you can also take a position with an expectation that the price is coming down. You profit when the price comes down by taking a short position. For example, let's say that you believe the overall economy is actually to grow and become more stable in the future. Now, you might decide to invest in a futures contract for an index like the FKLI, which stands for the FBMKLCI futures, which actually represents a broad cross-section of a Malaysia stock market. If the index goes up, you can sell the contract for a profit. But if the index comes down, you can sell the contract and make a profit in that way as well. So besides that, when you trade futures, you won't be facing challenges like you do in the stock market. You don't need to pick individual stocks to invest in. Now, for those who have experience in investing or trading in the stock market, I'm not quite sure whether you agree with me or not. If you agree, you can type in the chat box. Well, you know that you understand that stock picking has never been quite easy. Am I right? Even if you have a stock screener, even if you have stock software to screen through your stocks, stock picking still remains challenging. In Bursa Malaysia, there are 1,000 over stocks for you to filter out, maybe let's say 10 stocks or even 20 stocks for you to trade. Also, for stocks, besides monitoring the general market conditions, you still need to analyze the company's financial strength, the industry, the sector outlook. You need to look into the company's management, the products and services the company offers to the market, and many other fundamental factors. So I'm not quite sure whether you agree with this or not. Stock trading, it has a lot of a lot of process, a lot of hassle to do. So if you agree with this, you can type in the chat box, because do let other participants here know that stock trading, you are not just only alone, because stock trading indeed it's quite a little bit difficult, because stock picking, it really actually requires skills. It requires a lot of effort for you to do that. If you agree with this, stock picking is not simple. You can type in agree in the chat box, so that let others know they are not alone. So which is why futures trading is something that you can actually simplify some of your job as compared to the stock market. In futures trading, you can invest in the general broad market. So, for example, FKLI represents the Malaysia general stock market as a whole. It derives its value from the FPMKLCI index. So it consists of the top 30 market capitalization stocks in Bursa Malaysia. So the cost of entry for you to invest is actually way lower to invest compared to directly investing to those 30 market cap stocks. And other than that, other than the FKLI index futures, you can also choose from a range of futures products that actually cover different asset classes that also have a good diversification benefits. A few of the futures products, for example, like FCPO, FEPO, and FGLD. So this means you can easily diversify your portfolio and reduce your risk exposure. And later on, I will share with you about diversification benefits in detail later. Futures trading is often simpler than stock picking, because it focuses on the macroeconomic factors such as interest rate, inflation, economic growth, rather than analyzing the individual companies. Because all you need to do is just to stay informed about the broader economic picture. Then you can make informed decisions about which futures contract to invest in. To summarize, futures trading allows you to profit from upward as well as downward price movement. It's relatively easier than stock market, as you don't need to pick and even filter individual stocks to invest in. So that by focusing on the general market and macroeconomic factors, you can actually speed up your decision making in trading. Now, the second benefit of futures trading is actually on liquidity. Now, a lot of people, as you begin in trading, you might see that liquidity is not an issue at all. But as your wealth increase, as your portfolio increase, liquidity will actually be an important factor for you to consider when it comes to trading and investing. What liquidity means is that it refers to how easily you can buy or sell, or in short, how easily can you enter or exit the market without causing a significant change in the price. So compared to the stock market, futures trading is highly liquid. This means you can buy and sell futures contract quickly and easily at any time during market hours. So for example, let's say you bought a futures contract for the crude palm oil, and you need to sell it quickly to raise some cash. Because there are so many buyers and sellers in the futures market, you can easily, find another trader who wants to buy the crude palm oil contract from you. So which means you can actually enter and exit the market very quickly and easily. Unlike the stock market, during bad times, especially, when the sentiment is weak, or when there's a lot of bad news in the market, buyers usually does not want to get into a particular stock. So if you are a seller, you're holding that particular stock, you want to sell your stock and get out from it, correct? And it's very challenging for you because you couldn't find any buyer that will be willing to buy at the price for you to get out. So you can see that in stock market, there is a challenge in terms of liquidity as compared to the futures market. Another advantage of futures trading is that sellers are not required to own asset in order to sell futures contract. So this makes it easy for you as a trader to engage in shorting the market, where you can actually sell futures contract with an anticipation that the price is actually coming down. So short selling can be a useful strategy for managing risk as well as profiting when the market is coming down. And finally, futures trading tend to have lower transaction costs than any types of trading, because this is because futures contract, they are standardized, which means there are fewer associated fees. In contrast to other financial products like stocks or even bonds, which may have lower liquidity and higher transaction costs. So for example, if you want to invest in the broad Malaysia stock market, you need to buy the, all of the 30 top market cap stocks, right? So it's very high cost for you actually to buy all 30 stocks, as it incur high transaction costs and takes time for all of your orders to get executed. But you can do so with just entering FKLI futures contract, and this is equivalent to investing in all of the top 30 market cap stocks. It's very easy and having a low transaction cost. Now, the third benefit is on leverage. I believe a majority of you understand what leverage is. Leverage is actually, in futures trading, is a very powerful tool that allows traders to actually control a large amount of asset with relatively small amount of capital. So this means that you can make a potential large profit from a small investment. However, it is important to remember that leverage also increase your potential losses. So while the potential for profit is also greater, so does the potential losses. So for example, let's say you want to buy a futures contract for FKLI, but you only have 4,500 to invest. So let's say currently the FKLI value is 1,400. Multiplied per point is $50 per point, right? So one contract for FKLI is worth $70,000 for for, let's say, if you will want to buy the top 30 market cap stocks. So by trading futures, you don't have to pay the full amount of 70,000, and with leverage, with just only the initial margin. So currently it's 4,500. You might be able to control 7,000 worth of FKLI. So here you can see that your initial deposit, okay, divided by 70,000, your initial deposit required yet is only 6.4% of the total contract value. So now let's say that you have already made 20 points in FKLI, regardless of when the price goes up or goes down. Let's say you make 20 points profit. So that 20 points times 50 would be 1,000 ringgit, right? So comparing with investing using the full amount of 70,000, if you use futures contract, you can see that you are able to magnify your return because you have leverage. If the price of FKLI goes up or comes down, you make a larger profit than as compared if you simply invest 4,500 outright. However, if the price of FKLI goes down, similarly, you could potentially lose more than your initial investment. So here, what I would like to highlight to you is that futures trading, you don't have to come up with a whole big sum of, for example, in this case, 70,000 for you to capture the whole market. You just need to pay for the initial margin in order to, reap the benefits when the price, goes up or comes down, provided you are in the correct direction. And this is where the return that you get is considered as leverage return. Now, another example, let's say you want to buy a futures contract for FCPO, but you only have 9,000 to invest. So let's say the current FCPO value is 3,400. So multiply per point is 25 ringgit. So one contract for FCPO is worth $85,000. By trading futures, you don't have to pay the full amount of 85,000. With leverage, with just only the initial margin, currently 9,000, you might be able to control $85,000 worth of FCPO. So if the FCPO price goes up, you stand to make a larger profit there as compared if you had invested the 1,000, outright. However, if the price of the FCPO comes down similarly, you could potentially lose more than your initial investment. So it's important, for you to use leverage wisely only when you have a solid understanding of the risk involved. In fact, you as a trader need to be responsible for your decision, because traders should always have a risk management plan in place to help you protect yourself from excessive losses. And fourth, which is hedging. Hedging is a way to reduce the risk of losses by offsetting them with gains of another existing investment. So, for instance, if you own a portfolio of stocks, because I believe majority of you come from stock trading background, right? Let's say you own a portfolio of stocks that you think, the economy is coming down, your stock's price is going to come down. So in fact, you can actually hedge your position by selling futures contracts for your portfolio. So if the stock market comes down, so your stock portfolio, let's say it will be losing its own value, right? So your loss on stock portfolio will be actually offset by the gains in futures contract. So one side you lose in your stock, another hand you make money from the stock market. So this is where you are able to neutralize or having an offset benefits by hedging, using futures contract to hedge against your portfolio. Now, this might not be relevant to you as retail traders, but when you understand this, you can have a broader overview of how the market dynamics work. Another example of hedging, in this case, is like airline companies. Airlines often buy futures contract for crude oil in order to protect themselves when the price increase in the future. So in this way, they can lock in a price for their fuel costs and avoid potential losses if the crude oil price rise. Similarly, this applies for the crude palm oil producers and users as well, because they can use futures contract to do hedging and manage their risk. So by hedging, you can actually reduce the risk of loss in your portfolio and protect yourself from market volatility. However, it is important to note that hedging also it may reduce your potential profits, because there is always a trade-off between risk and reward. So as a retail traders, most of the time, if you like to do hedging, you can actually use the index futures to hedge against your portfolio value coming down. And lastly, on diversification, it's actually a strategy that involves spreading your investment across different aspects of markets in order to reduce risk. So by investing in a variety of assets, you are in fact less exposed to any one asset performance, and better position yourself to against any downturns, because futures trading can be a useful tool for diversification, because it allows you to invest in a wide range of assets such as commodities, futures, currencies, and even stock indices are all in one place. So let's say if currently you invest in the stock market, you diversify your stock portfolio by having different companies, different sectors, and different industry. However, you need to realize one thing is that no matter how you diversify in the stock market, all of them still falls under the same asset classes. All of them still falls under the same category of product. So if the stock market generally comes down, your stock portfolio, no matter how well you diversify, the value may come down as well. So for example, let's say you invest in a stock a portfolio of stock and bonds. While these are the common investments, they both actually affected by different factors and can be volatile in different ways. So when you add futures contract, for example, for commodities like gold or even crude palm oil, you can diversify your portfolio and reduce your overall risk. And this is because commodities tends to have different market drivers and may perform differently compared to stocks and bonds. And commodity markets, it also provide a hedge against the risk of other traditional investments. Additionally, by investing in futures contract for different assets and markets, you have the potential to also increase your overall returns. This is because different markets may be performing well at different times. So by diversifying, you can actually capture gains across a range of investments. However, also it's important for you to know that that diversification does not guarantee profits or protect against losses, and you should always carefully consider your investment objectives and risk tolerance before investing in any assets or market. Now, coming to topic number 3, when you understand the types of futures market, then it's easier for you to do your analysis, especially fundamental analysis. Different types of futures market, they emphasize on different aspects of fundamentals. Now, as you may have already known that these are the futures products available in Bursa Derivatives Malaysia. And the popular futures product falls under these two categories, the commodity derivatives and equity derivatives. Now, these two categories of products looks at different fundamental aspects. I'm going to share with you what makes both of them very different from each other, so that you can see how you can actually take advantage of trading opportunities available in them. Now let's go on to the first commodity products, which is your equity futures. For equity futures, we have two popular products, which is the FKLI and FM70. Both of them are following and tracking the underlying index. For index, for example, the FKLI, it actually tracking the FTSE Bursa Malaysia KLCI index. It derives its value from the top 30 market capitalization stocks. So you can see that it is highly correlated with the stock market. Highly correlated means it tracks very closely with the stock market. So when the stock market goes up, FKLI will follow accordingly, because it's like a parent and kids, right? Your equity futures is actually the sun, and the FKLI index is actually like the parents. So the sun would track or follow the parents very, very closely. And although in FKLI, right, in your KLCI index, in the index component, the 30 market capitalization stocks comes from different industries, right? You have banking and financial sectors, you have manufacturing sectors, you have servicing sectors, you have consumer industry as well. So the 30 market cap stock itself for the indices, they come from, it has components that comes from different industry. So the index itself is already well diversified. That represents the broad market for Malaysia. So you can see that when you trade equity index futures, you don't need to focus all of the components in the index. Okay, so trading equity index futures, all you need to do is actually focus on the general market sentiment and the macroeconomic factors, such as looking at the global economy, the country's fiscal and monetary policies, as well as some of the global news. So relatively comparing with the stock market, it gives you an easier analysis. You don't have to look at all of those individual stocks. All you need to look at is at the general markets. So this is when you trade these equity index futures. Similarly, index futures, you can use it for hedging purposes as well, because it allows you as an investor to protect against potential losses in your portfolio. So when your stock portfolio having losses is when your portfolio price coming down, right? So this is where on the other hand, you can actually sell index futures, whereby you can protect yourself against market downturns. So this would actually allow you to have offsetting position. When your stock comes down, you lose money. When you take a short position in your index futures, although it comes down, but you make money. So both of them are able to have an offsetting position. Earlier on, I do mention that, remember during market downturns, right? Generally speaking, it's very challenging to sell stocks, because during market downtrend, or when there's a lot of negativity, negative news, or when the sentiment of the market is very low, very negative, the liquidity, generally speaking, is low, and few buyers are willing to buy because of fear. So in fact, during negative times, liquidity will shrink quite greatly for stocks. And if you have futures, index futures here, you have high liquidity with large numbers of buyers and sellers, making it easy for you to enter as well as exit your position quite quickly. So if you are unable to sell your stocks, at least you can hedge it first, and then as you sell your stock, you can slowly reduce your futures position. So here you can see that these are the uniqueness of equity index futures, especially for the index futures. And next, which is the commodity futures. Now this category is a little bit different, because in Bursa Derivative Malaysia, we have FCPO, we have FEPO, as well as FGLD. All of them are considered as commodity futures. So as you already know, commodities are actually raw materials, unprocessed materials yet, that can be further produced and manufactured in order to create a final products. Now, analyzing commodity futures is very different from equity index futures. Why? Because commodity is a separate asset class. So remember the first topic I shared with you earlier about the structure of futures market. Commodities generally deal with the real physical products. It is raw materials that will be used to produce the end products that we will use and consume in our daily lives. So for commodity futures, it is based on pure demand and supply dynamics. I repeat again, commodity futures, it generally is based on pure demand and supply dynamics that influence the price movements. So unlike commodity companies, because when you trade commodities, it's different from trading or investing commodity companies. When you trade or investing in commodity companies, you still need to do stock picking, picking the best commodity or plantation companies. You need to filter stocks. You need to find the best commodity companies that has good management and good earnings. But when you trade commodity futures, you are actually directly trading the futures contract for the physical products as well. It has nothing to do with stocks or commodity companies. So which means, in other words, when you trade commodity futures, you are directly involving, in trading the commodity physical products. Now, let me share with you this important chart. Probably for those of you who may not be able to relate why it is important for you to take commodity products. One of the benefit for adding commodity products into your portfolio is because of its low correlation. Now, low correlation means is that it has a low relationship, or it actually does not follow the other markets. So in this chart, what I would like to highlight to you about the correlation is the correlation between the stock market as well as the commodity futures market. On the top is the FBMKLCI, which represents the stock market. So this is where you are trading or investing in the stock market. And the bottom, which represents the FCPO, it represents the commodity futures market that you can trade in Malaysia. So later on, when I go segment by segment, you can see whether the price goes up or goes down, and whether both markets are actually having the same price movement or not. So the first one, you can see that for the stock market, when stock market goes up, you can make money. For if you trade the commodity futures, you can take a long position, you make money during an uptrend as well. So find both markets, you can make money. Now, on the second phase, when stock market comes down, you lose money. But for commodity futures, you can also take a short position by betting the price coming down. You can make money from commodity futures. Similarly, again, you can see stock markets going sideways. You are not likely to make money from stock market, but for commodity futures, you can take a long position by capturing upward price movement. And similarly, as we progress to the right hand side, you can see that both stocks and commodities, both of them has different degrees of price movement. So you can see for the stock market, black color sideways means that you're unlikely to make money. Red color means you lose money in stock market. But for commodity futures, you are very likely to, with a good strategy, you can actually both capture uptrend and downtrend as well. Okay, so this is what I would like to highlight to you, is that the correlation between the commodity futures market is very low compared to the stock market. Whatever the stock market does, it does not affect the commodity futures market over the long run. Another closeout example, which is the recent 2 to 3 years, is that you can see that for Malaysia stock markets generally is going at a sideways, right, within a range of 300 points for your index future, for your FBMKLCI. But for FCPO, which represents the commodity futures, it is quite a general big uptrend. In fact, it's what we call as the commodity super bull cycle, where if you are in the commodity markets, you are able to more or less capture or reap the benefits if you were to add futures product in your portfolio. Now, lastly, topic number 4. For in this section, I am going to briefly share with you about the futures contract and how you can actually briefly calculate futures profit and loss. So if you would like to learn more about futures trading or things that are related to futures product, I highly suggest you to participate in the LLF online workshop, because in this webinar time is limited, so I'm not able to go so much detail in it. So if you are interested in further your learning in futures trading, I strongly encourage you to participate in the LLF online workshop, which will discuss this topic in greater details. Now, because you are trading futures, all futures contracts are standardized contracts. So just now I shared with you the history of futures exchange, how does futures market comes by, and why futures contract needs to be standardized, right? So to make it simple, contract specification here refers to the terms and conditions. Okay, contract specifications means the terms and conditions that define your particular contract or your agreement. So it actually outlines the specific requirements, parameters, and rules about your contract. So when you trade futures, you need to understand what are the contract specifications for the futures product that you're trading. So for example, this is the FKLI contract specifications. There are more specific details that you can actually read in Bursa Malaysia website. So I do encourage you that, when you have your free time, do explore Bursa Malaysia's website to read further details on the contract specifications. Here, I am just highlighting to you a few important points that you must know. So here you can see that you have a contract code, underlying instrument, and there are the FKLI trading hours is a little bit extended compared to the stock market. And some of the important things you need to know is that for FKLI, the price movement is 0.5 points. Every time when the FKLI move, it goes by 0.5 points. And for 1 point of FKLI, it represents $50. So whenever you make 1 point from FKLI, you actually make $50 out from it. Now, a quick question for you. Now, for those of you who are still new in trading futures, you can actually have a quick guess. So here are a list of FKLI contract that you can trade in. We have 3 key contracts. Now, which of these contracts that for you as a retail trader that you can trade? Can you let me know your answer? Are you going to trade which contract month? Are you going to trade the first contract, second contract, or third contract? You can type in your answer in the chat box so that I would like to see what is your understanding about futures trading. Okay, I see some answers coming in. Some say the first contract, some say the third contract. Okay. Interesting. I see some put second contract, some put trade all. Okay. So for which is why this class is very important for beginners, right? So so that you don't have to make unnecessary mistakes in trading. Now, for example, now it's already 30th of May, right? So assuming now it is still beginning of May, the actual contract that you need to trade is actually the first contract that is appearing on your trading platform. Okay, why? It is because you can see on the right hand side the volume is the highest amongst all. So very general rule, whenever you trade whatever futures contract, all you need to do is select the futures contract that has the highest volume for you to trade. Okay, so let's say when you trade FKLI or the index FKLI futures contract, you always trade the first spot month contract. So right now is May, so you trade May contract. So for next few days, which is already June, so you will be trading June contract. You trade the same contract for the same month that you are currently in. Okay, so these are the general rules. Now let me give you a quick example here how to calculate your profit and loss. So this is a typical FKLI chart. So let's say you buy FKLI, enter a buy position for FKLI at 1,400 level. And then later on, when the index goes up to 1420, you just sell it out. So how do you calculate your profit and loss here is that it's very simple. Because you buy low and then later on you sell high. So this is where you are having a long position. So very simple. You take 1420 minus 1,400. You buy low and you sell high. So which means you are making 20 points. Am I right? So 20 points, remember your contract specification, 1 point is $50. So 20 points times $50. So this is where you will be making $1,000 profit out from it. Very simple, right? For calculating FKLI. Now let me give you another quick example. Same thing, also FKLI. So let's say you see, you think that the market is negative. So this is where you decided to take a sell position in the market first. So which means you sell first and then you buy back later. So you sell at 1432, and then when the market goes down at 1416, so this is where you sell first and then you buy it back later. So can you more or less do a quick calculation? What is the profit that you will be making from this position? I give you around 10 seconds to think about it. You sell first at 1432 and later on you buy it back at 1416. I see there is answer up in the chat box already. So now you sell high and then you buy it back low. So 1432 minus 1416. So here you got 16 points, right? And 16 points you times $50 per point. So you will be getting $800 a profit. Okay, so you can see for FKLI it's very easy for you to understand. Now let's move on to another popular product for futures trading in Malaysia, which is the crude palm oil futures, in short, what we call as the FCPO contract. So here are the trading hours. It's a little bit different from FKLI. The trading hours is actually, it starts from 10:30 until 12:30, and then 2:30, same thing, same as your stock market opening afternoon session until 6 p.m. Not 5 o'clock, until 6 p.m. So of course, this FCPO is a little bit different from FKLI. So you need to be familiarized with the trading hours and read a little bit more detail of the contract specifications from Bursa Malaysia website. Okay, I believe there is a brochure for you to read. Later on, I'm going to share with you how to get and find this information. So for FCPO, the minimum price movement is $1 every time. So and each of these price $1, it represents $25 dollars. So $1 movement equivalent to $25 dollars of profit and loss. Now, same question again. You can see that for FCPO, they're a little bit different from FKLI, right? There are a whole list of number of contracts here. Now, as a retail traders, which of the contract that you should be trading as a retail trader? So again, let me give you a hint. Let me know what are the answers. Let me give you a hint first is that you need to find the highest trading volume in order to trade. So if you are able to find the answer here, you can type your answer in the chat box. When you trade futures, very easy. You always find the highest volume month in order to trade. So this is where you have the highest liquidity, highest liquid contract month. So okay, all of you put July. Okay, very good. Seems like you have already learned something, right? When you trade commodity futures, you always trade at the third contract month. If you do not know which contract month, always see what are the list of contracts and then find the highest volume to trade out of it. Okay, a very general rule. A rule of thumb is always find the highest volume to trade. Now, similarly, let me give you a quick example how to calculate profit and loss for your FCPO. Let's say you buy at 3,600 first, and then later on when the price goes up, you sell at 3,760. Are you able to calculate your profit and loss here or not? Very simple, because you buy low and then sell high. So you take the price difference, 3,760 minus 3,600. So you get 160 points, right? So 160 points times $25 per point. So this is where you get $4,000 in profit. Very simple, right? The calculation is exactly the same as how you calculate FCPO. The difference is the per point value is different. For FKLI, per point is $50. For FCPO is $25. Another quick example. So let's say at this particular point, you see that the price is not good. So you sell at $4,000 and then you buy it back at 3,700. So you sell high and then buy it back low. So I believe you are able to find the calculation answer very easily. The difference is 300 points times $25. So you get 7,500 in terms of profit. Okay, provided you get the correct position. Okay, when you expect price to go down, you need to take the short position. when you expect the price to go up, you need to take a long position. If you get the wrong position, this 7,000 instead of 7,500 profit, you will be having 7,500 of losses. So of course, when it comes to futures, they are a little bit jargon, so which is why it's important for you to equip yourself with the necessary knowledges before you start your first futures contract. All right. Now let me share with you where you can find more readings for your futures contract specification. You can actually go to Bursa Malaysia website, which is this www.bursamalaysia.com, and then you go up to the blue color bar, the blue color menu bar, where you can find a trade, and then you go to on the second column, which is you can find derivatives there. When you click on derivatives, you will come to this particular page. So this is where you can see all of the futures product here. So you can click either one of it. If you're interested in FCPO, you can click on the commodity derivatives. There will be a drop down, and then you'll find crude palm oil. So in it, you can find some of the brochures for a different futures product, and I think it comes with 2 or 3 different languages. So just take your time and learn about it, because it's important for you as traders to be responsible in terms of learning and equipping the necessary knowledge before you actually put your real money into trading futures. All right. So that's it for today. Let me summarize what are the 4 key takeaway points. So of course, firstly, futures market consists of 3 key market participants, which is your hedgers, traders, and arbitragers. And I've already highlighted to you what are the benefits of futures trading. Although it seems quite easy, right, these benefits, but as you explore a little bit further, you will really realize that these few benefits of futures trading is really, really different from trading the stock market, because futures market the market is structured in a way that is really different from the stock market. So this is why you can take advantage of the futures market in helping you enhance your overall portfolio return, as well as diversifying your risk. And of course, there are 2 types of futures market. The first one, which is the index futures, and then next one would be the commodity futures. Commodity futures, it's unique because it has low correlation towards the stock market. So when you add commodity futures in your overall portfolio, right, it can actually help you to lower down your overall portfolio risk. And lastly, do note that the futures contract specification, it's very, very important for you to trade, so that you don't enter the wrong contract. Always learn the basic, first go through a proper education before you actually put your money in futures contract. Okay, so that's it for today. I will pass this back to Ting Ting.